Okay, afternoon ladies and gents. Hope you all had a good weekend. Let's check out these markets then, and kind of a bit more, we've kind of drawn a line under last week. New week today, and last week was pretty negative throughout. We had bad data kind of all the way through. And as you can see on this 4-hour chart, I've got the whole of September pretty much here on the chart, and we had a pretty significant leg lower after Monday's brief respite, where we had a pretty good rally off the back of no data. There was some mergers and acquisitions story just fueling the upside there, but it was a very light volume day, so you can kind of almost disregard that. So really, for the last 2 weeks, we've been forming a bit of a downwards trend, and this culminated with the worse than expected non-farm payrolls data on Friday, of course, which came in at minus 263,000, worse than expected, and we hit a low down at 10.12. Now, we're just going into this week, obviously a new week, and I just get the sense that people are a little bit more optimistic. We've had some good data out of Europe this morning. We've had the Eurozone PMI services data, came in better than expected, and it's above 50, i.e. showing an expansion for the first time in 16 months. Also, particularly the UK services sector expanded at its fastest pace for 2 years, and companies are more optimistic about the next 12 months than at any other time since April of 2007. Okay, so some pretty positive stuff that kind of goes in the face of the negative sentiment that we had, particularly last week. Now you'll recall, let's just see, in terms of September as a whole, the low of September was 986.50. I've got my Fibonacci series on this chart looking at the high and the low of September. We did get below the 61.8% line at 10.20. We did dip below there on Friday with the non-farm news, but we're now back above that, and with kind of 50% line coming in at 10.31 is kind of our next sort of upside target should this positivity continue throughout the session today. So we'll be looking at 10.31.25 as our kind of upside target if we're going to start to reverse this bit of a downtrend that we've been seeing. But definitely a different feel about the markets this morning with this good European news. Let me just zoom in. So this is the hourly chart. And I just want to reiterate again what happened at the back end of last week. So we had a big sell-off on Thursday. We had some worse than expected data on that day, but it wasn't that bad. It wasn't that bad that it justified such a huge sell-off. This was the biggest sell-off, for over a month, daily decline for over a month, and the data did not justify that. What people were doing were gearing up for Friday's non-farm payrolls data. Okay, people were taking some risk off the table, and this certainly led to a lot of that decline. And Thursday's market movement goes some way to explaining what happened on Friday. So the big red candle here we had, of course, was following the announcement that 263,000 people had lost their jobs in the US in the month of September. We'd been expecting something more like 175 or 180, so it's quite a lot worse than expected. But a bad result had kind of been priced in the day before. So what we saw was a big sell-off down to 10.12, and then a complete retracement of the entire move. So really sort of an hour and a half to 2 hours after the data release, the market was back where it was prior to it. So this can be explained two factors. First of all, what I've just mentioned, Thursday's session, and to a certain extent the whole of last week was all about pricing in some pretty bad jobs data, and we got pretty bad jobs data, but because it was largely priced in already, it contained the further move lower. Secondly, you've got to look at the dollar on Friday. It played a huge part in terms of stock market direction. Okay, and we're looking at the dollar correlation into this week as well. It's particularly high, and on Friday what we saw was Immediately after the data release, we saw dollar strength. That is a flight to safety trade. The dollar is the the currency to be in during times of economic difficulty. So that's just a flight to quality. Okay, so we expected the dollar to strengthen after that non-farm payrolls data, but then what we saw in the dollar was a complete reversal. And actually, if you look at the euro dollar in particular, not only did it reverse back to where it was trading, it then swung completely in the other direction and actually showed a lot more weakness on the day than it had shown strength following the data release. And it was this kind of complete swing in the dollar situation that also fueled the way for the stock markets to make its way all the way back and fully retrace the non-farm payrolls data. So kind of two factors in play that describes and explains Friday's market movements. One, the fact that a bad data release had been priced in largely already, and number two, the reaction of the dollar. Now we're going into this week, and it's quite an important week, not for economic data, because the economic calendar is fairly light this week. It's more about the quarter three earnings, which are going to begin on Wednesday with Alcoa, who traditionally kick off these quarterly earnings reports. They're going to be reporting on Wednesday, and then it's really from there for the next 3 or 4 weeks that we're going to continue to get daily quarter three earnings reports from the biggest companies in the US, and this is what is going to give this market direction for the next month to 6 weeks. Okay, now Amplify Trading's stance on this is that the sell-offs we saw in the last 2 weeks, culminating in the spike lower down to 10.12 on Friday, actually presented a perfect buying opportunity for the medium-term investor. People who are bullish on quarter three earnings will be viewing the current level of the market as the ideal opportunity to get long for the next leg higher. And the quarter three earnings, in our view, are going to be good. They're going to come in better than expected. They're going to show some reasonable top line, revenue growth, and we feel this is the driver that's going to take the markets, that's going to continue the longer term uptrend. We've had 7 up months in a row. We definitely see 8 up months in a row. So what we need is quarter three earnings to start coming in better than expected, and for this market to retrace the losses that we've had in the last couple of weeks. It might be a quietish session, although we do have ISM non-manufacturing today, which is at let me just get the time for that. It's at 3 o'clock today, and significantly we're expecting a figure of 50. Okay, now anything above 50 shows that this sector is expanding. We haven't had a figure above 50 for a long time, certainly not this year, and what we are expecting is for the ISM non-manufacturing to follow the European data that we had this morning, and we think it's going to be 50 or better, and we think this is going to boost the markets higher this morning. I think we can retrace. I've got a Fibonacci series on this 1 hour chart here that's looking at the high. Let me just get the high in. It's not quite on this chart. So the high from the start of last week. We have a 38.2% line, which also corresponds to today's R2 pivot level. That's at 1036. We think with good data at 3, we can certainly get up to that level. I think that's an important level. That's the first major sort of resistance level for this market to get back higher, because it was also the lows that we saw on Monday. So Monday's session last week, where we had a pretty good rally off the back of light volumes. That's so we kind of got 3 levels coinciding here. Fibonacci level, we've got a pivot level, and it's the lows from the beginning of last week. So that's our main resistance line, 1036.25 for today's session. If we get good economic data at 3 o'clock, we see that being tested, and we're pretty bullish from these levels for the medium term. Why do we think quarter three results are going to be better than expected? We believe that at a corporate level, the US has has factored in a much worse recession than we've actually got. Okay, so how have they factored that in? What do companies do in times of recession? They cost cut. How do they cost cut? They lay people off to reduce their labour costs, and they significantly reduce their inventory levels. So they decrease production and they decrease inventory levels, because carrying stock costs money. So currently